Hi and welcome to Swiss Codes Daily Market Talk. It's Jobs Friday, January 10th. The US dollar extends its advance this morning and the yields are climbing before the release of the latest jobs report from the US this afternoon. But sentiment could rapidly change depending on what the data will look like. But first, in the absence of the US yesterday, the UK set on the headlines with its debt drama. Everyone threw in what he or she actually thought about what today's situation in the UK reminded them of. The discussions went from the latest aggressive sell-off that was triggered by Liz Truss' mini-budget disaster to 1976 debt crisis when the UK had to ask the IMF help to get its head above water. Now, I don't really think that the UK is there just yet, honestly, and yesterday's retreat in yields after reaching fresh highs, but without the Bank of England's intervention this time, was more than welcome for investors. But the fact is, Rachel Reeves is losing her fiscal headroom and her maneuver margin with every basis point rise in borrowing costs, and that obviously muddies the Britain's growth outlook. The 10-year gilt yield in the UK has risen around 60 basis points since Rachel Reeves' latest budget announcement. The yields didn't rise as spectacularly and as immediately as it was the case with Liz Truss' mini-budget disaster. But the fact is that, the yields in the UK are right now above Liz Truss levels, and that leaves the UK with, pretty much three choices. One, they could announce more tax rises. Two, they could lower spending. Or three, both. Now, according to these people who are familiar with the matter, it would be rather the second option, lowering spending, at least in the first instance. Maybe, but just maybe, that's what brought actually some relief to investors at yesterday's trading session. But all in all, and in all cases, the UK's drama is not over just yet. Cable has now slipped below the 1.23 mark and is clearly set for a deeper sell-off. Price rebounds that we might see in sterling could actually be interesting opportunities to strengthen short positions against sterling and target the 1.20 support against the US dollar. And on the euro front, we should actually see consolidation and probably extension of the latest gains in favor of the single currency. But I actually think that the upside potential of the US dollar against sterling could be higher than the euros. Now, one fun fact before we move on. The United Kingdom, which obviously does have a huge debt on its shoulders and also dismal productivity and dismal growth and a thick layer of unnecessary regulation like continental Europe, for example, still has a debt to GDP level lower than other developed economies like France, Italy, Spain, and Japan, for example. But the country, the UK, actually faces a relatively tougher reaction from the market to its political decisions. And I have the feeling that investors around the world somehow continue to blame the UK for its decision to quit the European Union. Maybe, but just maybe, I'm overthinking, but this is how I feel. But anyway, in summary, the sell-off in British gilts and the pound may have cooled down yesterday, but cost of boosting growth has become significantly more expensive for the UK's government, meaning that we may not actually see the United Kingdom's economy perform as well as it did over the course of last year. And that sets the pound outlook negative at the very early weeks or the first week of the new year. Now, moving on, the euro dollar actually also continued to be sold at yesterday's trading session in the absence of American traders yesterday, and the pair is now trading below the 103 mark heading into the US jobs data. The selling pressure here is backed by strong dovish expectations from the European Central Bank that were, in return, backed by the French Central Bank head François Villeroy's view that the European Central Bank should cut its interest rates at every single monetary policy meeting into this summer to reach that neutral rate. Now, I doubt that his German equivalent shares the same exact opinion after inflation in Germany jumped to 2.9% last month. But we will see. In all cases, the euro dollars and the other major currencies out there's short-term direction will obviously and likely be set by the US dollar, because the US will be releasing its latest jobs data today before the closing bell, and well, the jobs numbers from the US could help slowing the fast progress that we see in Federal Reserve hawks these days that actually resulted, along with the US debt worries as well, in rapidly rising yields. Now, keep this in mind. Before the announcement of the US official jobs data today, activity that we see on Fed Fund futures suggests that the Fed's next interest rate cut will arrive in May with around a 53% chance. A set of stronger than expected data could eventually flip this expectation to the no cut until June side very, very rapidly and enhance the sell-off in US Treasuries and also support a further appreciation of the US dollar into the closing bell. While a set of softer than expected jobs data from the US today could strengthen the hope of a May cut from the Fed, but given how fast the Federal Reserve hawks gained field over the past few weeks, and also given how much more exciting investors are over dovish factors and dovish expectations, well, the market's reaction to soft data from the US today could be, well, bigger than the reaction to potentially strong job figures. So the expectation in numbers is that the US economy may have added around 164,000 new non-farm jobs in the month of December. That's well below the 227,000 added a month ago. But that number was boosted by the strikes and hurricanes of the month before, mind you. So the fall won't be as bad as it could first look. Then, the average earnings in the US is expected to remain highly sticky near the 4% mark on an annual basis, which is obviously a problem and would be bad news for the Federal Reserve because people who earn more tend to spend more as well. And finally, the unemployment rate of the US is seen steady near the 4.2% level. Again, strong NFP and wages growth would be supportive of the US dollar today, while soft NFP and wages growth data is normally expected to lead to a pullback in the US dollar and in the yields. But if we have mixed figures today, I think that wages growth side of the story could overweight unless of course we see an alarmingly high or low NFP figure. This morning, just before the data release, the US dollar is strongly in demand, the US Treasuries are under pressure, and the US yields are rising. So let's see. Let's cross our fingers on how sentiment will evolve into the closing bell of this week. Now, across the Pacific Ocean, on the flip side of the world, the Chinese are actually struggling with a completely different problem. Because despite the announcement of multitude of stimulus measures there, that goes from fiscal to monetary stimulus, while yields, the Chinese yields continue to plunge, hence the gap between the US and Chinese 10-year yield, for example, and other yields are widening, and they're widening alarmingly. And we hear the word or the phrase Japanification of China pronounced very often since last year. The Japanification referring to inability to boost spending and boost investment despite lower interest rates. That's probably the worst disease for an economy and takes very, very long time to heal. So the CSI 300 index in China experienced its worst start to a year since 2016 and is finding it quite difficult to rebound on these low yields. The yuan is weak these days and weakening, and the Chinese are actually expected to let the yuan weaken further as an additional tool or an additional arm in the trade war against Donald Trump and Europe. But low yields and prospects of a weaker yuan make it harder to convince foreign investors to bring in money, while the economic growth remains quite lackluster. So the Chinese problems are not over. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.